Hello, hello. It's good to see you. When it comes to real estate investing, there's a common phrase that you make money when you buy. But how do you know if the purchase price is good or not? For real estate investments, especially on the commercial side, when you're buying something, you are removing emotion entirely from the equation. So you're buying based off of an in-depth analysis that you're doing, whether that's on a spreadsheet or whatever tool you like to use. You're doing financial modeling, you've got your key assumptions feeding that model, and you are underwriting the property and the opportunity. And when you're underwriting, those assumptions or those key assumptions that you have feeding your model are going to often make or break your decision to move forward with an investment. And so it's important to be able to stress those key assumptions that you have in your model. And so that'll give you a worst case, a base case, and a best case as to whether or not an investment will perform. But how do you test or stress your underwriting so that you still know it's a good deal, even in dire circumstances? Hi, my name is Tommy Brandt. I'm with TB Capital Group. We invest in commercial real estate assets with a primary focus on apartments. And today, we're going to talk about 4 sensitivity analyses that you can do to stress your underwriting for apartment buildings. Let's jump in. But before we get too far into it, let's talk about what it is that we're testing and why it's important. So whenever we're stressing our underwriting and our financial modeling, it's called a sensitivity analysis. And so we're doing a sensitivity analysis on the assumptions that feed that model. And a sensitivity analysis is really just a tool used in commercial real estate investing, specifically for underwriting. And it assesses the potential changes of key assumptions or variables and how that relates to the financial performance of your real estate asset. And key assumptions like your rent growth, your vacancy rate, your inflation rate, your tax rate, your interest rate if you're trying to refinance, and then your exit cap rate or capitalization rate. It also helps you challenge your financial modeling. If we are analyzing the property based off of a range of key assumptions and the opportunity still looks pretty dang good in the worst of times, then it's maybe something to heavily consider. If we are tweaking some of our key assumptions and this asset is only going to make sense during the best of times, then it's probably a risky investment. All right, now that we got that out of the way, let's jump into the first sensitivity analysis, and that is going to be your break-even occupancy. Break-even occupancy is the occupancy at which your commercial property goes from having an operating deficit to an operating surplus. To put it another way, break-even occupancy is exactly like it sounds. It is the break-even point of occupancy to be able to afford your debt and expenses. Moving on to the second sensitivity analysis is going to be an interest rate test. And this really only applies if you are planning to refinance throughout the time of your business plan. So if you have a 5-year business plan and your idea is to add value over 2 or 3 years and then refinance, harvest some equity, maybe pay back investors, you need to test or stress the interest rate that you're planning to refinance at. Some business plans are less reliant on a refinance, and it's just a nice to have. It's an opportunity to harvest some equity, maybe pay back some investors. And then there's other business plans like new development where it is reliant and it is just fully expecting to refinance after a certain period of time because they have debt commitments as well as investor commitments to repay. And the reality is that loan terms, for the most part, are fluid within a certain range. And all this test is you're just testing for varying interest rates to find that pass and fail range to see where it makes sense to do a refinance or where it doesn't make sense to do a refinance. Moving on to the third sensitivity analysis, and that is the cap rate test. Cap rate, short for capitalization rate, is really just a market multiplier, if you want to think about it that way. It is a measure of the market's desirability, and it varies by class. Nobody can predict the future, and the longer your time horizon for your business plan, the less uncertain your future is. But generally speaking, if you're in a primary or secondary market that has a lot of draw and natural growth or organic growth, good jobs coming in, solid demographics, then that is a market with high desirability, and that's probably going to suffer less volatility in cap rate. The term cap rate expansion means that the market is getting worse, and cap rate compression means that the market is getting better. People are spending more for the same assets. And so whenever we're underwriting to account for cap rate expansion, which means that whatever we're doing needs to outperform the market getting worse in an investment. But also what this test would do is that would provide a range. It would provide a tolerance of cap rate. So if the cap rate does compress, what are our returns? If the cap rate expands more than we think it will, what are our returns? And it's important to know that because that is something you have no control over. Moving on to the fourth sensitivity analysis, and that is an NOI variance. NOI is short for net operating income, and it's a fancy term to just mean the profitability. So what is your income minus expenses? Expenses including your taxes, and then whatever the resultant is your NOI. This does not account for debt service or CapEx. This is highly dependent upon how well the operator is running the property, executing the value add business plan, sticking to budget. But this test is just a varying NOI depending on, do you overperform by 5 to 10%? How does that relate to the returns? Or are you underperforming by 5 to 10%? And how does that relate to the returns? And you can get more granular with these tests. I know we mentioned NOI, but you can do tests for rent growth or rent escalators, expense escalators. You can do tests for your vacancy rate. And there's ways that you can drill down and get super granular with testing your key assumptions. And that is 4 sensitivity analyses that you can use to stress the underwriting for your apartment investments. That's it for today. I hope there was something in there that was valuable. If there was, be sure to like and drop a comment on the video. If you haven't already, be sure to subscribe to the channel. It really helps out a lot. And if there's someone in your network that you think this would be valuable for, you have my permission to share the video. And if you're like me and you like real estate investing, then check out some of the other videos on this channel. Thank you for stopping by. Have an amazing day. We'll see you on the next one.